Okay, I think I'm recording it now, so I'm going to try to make you host once more. All right, Brandon, you are host. I am recording. The magic is made. We are ready to rock and roll, everybody. Okay, ready? We'll do our first live show, and I wanted to just welcome everybody to a live, not your average financial podcast where we have some special guests, many special guests, most importantly, our wonderful audience that has joined us here live on a beautiful Saturday, at least here in Chicago, but also very special guests, Amanda Neely. Welcome, Amanda.
Glad to be here. Thanks for having me.
And Brandon Neely. Welcome, Brandon.
Hey, thanks for having me.
So we've got some incredible content to cover, and Amanda, you've been kind enough to share some very cool, very, I think, unique material that you've done for yourself as a sample of one, but then you've been even willing to share with our listeners and our attendees on the live show together today a bit about what you've found and make it available for everybody. So first of all, tell us who you are. If folks don't know the illustrious Amanda Neely, tell us who you are and sort of where you are at this point in the financial journey toward financial independence.
Yeah, so I am Amanda Neely, and Brandon Neely and I host the Grandma's Wealth Wisdom podcast together. Brandon and I are married, not brother and sister, just to clear the air with that one.
People have thought so, that we were brother and sister, because I guess you look alike as you're getting married.
Yeah. I don't know. Brandon adds colorful commentary, and I'm the more serious one, if you can't tell that already, too. And we've been working with Mark as his clients for almost 6 years now. I think it was around this time 6 years ago when I finally figured out what he did and was kind of mad that I didn't know about it sooner. And then we started our first Bank on Yourself policies at a short time later. And when we were looking for a new career opportunity, we were thinking, how can we really make an impact in the world and help people improve their situation? And our story with money had been really impactful to us. So we thought, let's join and what Mark's doing, this revolution that he's a part of, and figure out how to do that. So Mark is one of our mentors, has taught us a lot. We still have a lot to learn, but we're into this now and really love helping people create safe and predictable financial strategies that they can rely on. So I think what we're going to talk about today is one of the most common things that has come up for me in working with people that are in their 20s and 30s. I just turned 35 this year, and I used this sample that we're going to look at today as if it was for me, and if I was making this decision as a fresh start as a 35-year-old. Trying to decide, do I do Bank on Yourself, or do I do this Roth IRA strategy, which has a lot of the same tax advantages under current law as the Bank on Yourself strategy, but is using the stock market with some term insurance instead. And that, from what I understand, is a very common alternative it's actually more for what people think is that the Roth IRA and term insurance is more common. It's what everybody is doing. That's what you should do. And so I thought, let's turn that on the head. Say, what could we not be like what everybody else is doing, and what would the results be? So I tried to run the math as unbiased as possible, and that's what I'm going to share today. So we're going to be able to see my screen and look through the numbers on my screen together. I apologize in advance for the people that are listening to the audio recording of this later. If you don't see the screen, I think we're going to have this posted, but there might be a little bit of a breakdown because you might not see exactly what I'm pointing at. I'll try to be as clear as possible.
Wow, okay. Yeah, you're right. So some of our listeners will eventually... the folks who made it a point to be here today are getting this first and foremost live and video. It'll eventually be an audio show eventually for the stragglers who had other things to do on a beautiful Saturday. But but yes, awesome stuff, Amanda. So give us the breakdown of what we're looking at here, and help us understand what is happening, what assumptions you made for these numbers on the screen.
Absolutely. So I'll start at the left and work our way to the right. On the left-hand side, you see the year and the age. A year from now, 2 years from now, 3 years from now, how old I will be at that point. And then you'll see the next four columns have the annual premium, what would go into a bank on yourself policy. I chose 6,000 because that is the current maximum for a Roth IRA. So I wanted to compare apples to apples there. And then you'll see the whole life insurance death benefit is the next column. That's what that 6,000 would get me with a properly structured bank on yourself type plan. And then the cash value that I'd have at the end of year one is the next column, or and the end of year two as you go down the rows. And then finally, the commission. I used real commissions for a real agent, aka myself. If I sold this policy to myself, what would my commission be? And so those four columns are summarizing the bank on yourself type plan. And then the next four columns are a Roth IRA with some term insurance so that we get a death benefit as well. You'll notice that the contribution to that Roth IRA is the exact same as the premium for the life insurance policy. The alternative cost, that is the 1.5% on average fees that are being paid to the money manager, the fund fees, all the different things that are involved with a Roth IRA. And I used 1.5% because that's the average. And then the alternative value, what I did to calculate that, so on the life insurance side, I get a nice life insurance illustration from a company. Those values are just copied and pasted from a real life insurance company. With the alternative value, we actually have to look at how the stock market has performed historically and use that to do the calculations. So this is pretending like this is the year 2000, and I start investing in a Roth IRA January 1st, 2000, and we do 2000 through 2018 in the S&P 500, and then we repeat that over and over again. That's the real numbers that I used for the alternative value. And then finally, for the term insurance death benefit, I took if I took the death benefit on the life and on the bank on yourself side, it starts at 234,000 and it grows by the time I'm 66 to 619,000. So I took roughly the halfway point, or if you look at around year 15, it's 482,000. So I used 475, have a nice round number as the death benefit for the term insurance. And I pulled a real term insurance quote from a real company, actually the same company that the bank on yourself life insurance policy is with as well. And I included that cost as part of the alternative cost. So you might be wondering why that alternative cost, if you did the math, is more than 1.5%. It's because there's a cost for the term insurance as well. So that kind of explains how I have it written out here. And now we can go throughout the years and see what we notice.
Before you do that, Amanda, you've covered a lot of ground here. So let me just reiterate for the sake of our listeners, maybe I'm the slow one, but what you're doing is you're showing a comparison between that big black line in the middle of the screen is the two different strategies, one a hypothetical world and another one is a different world. So on the left side of the page is you putting all of your $6,000 a year into a bank on yourself designed whole life policy. Is that right so far?
Correct. Yep.
Okay. So we've got 6,000 going in the first year. And the other alternative is that same first year you're putting in $6,000. And really what you're doing, if I hear you right, is you're putting less than $6,000 into the Roth IRA because you had to put some kind of money into your term insurance premium. Probably not a lot, because
right.
You're at young age and so forth. And what was the term insurance duration?
30 years.
30-year term. Okay.
Yeah.
And the death benefit, you chose $475,000 for the term insurance because it was the 15-year point halfway through your experiment. And you need to pick a death benefit. Why? Because the whole life death benefit on Bank on Yourself increases over each and every year. Am I tracking with you so far?
Yes.
So that makes sense. Year 15 to pick that midpoint on the term insurance amount. You could have picked any other number, but that makes enough sense. Okay.
Okay.
Great. Does anybody, we've already covered a lot of ground. So anybody, I'm sure there's a question or two already. And we might save them to the end, but if you have a question now, feel free to add them to the chat. Or you can bring you on live if you'd like to ask a question live.
Yeah, if anybody wants to go live, I can unmute you too. So if you want to raise your hand or anything, I can bring you on the call.
Can you tell them how to raise their hand if they'd like to? Where's that shown?
I think on the chat, it says raise your hand, I believe there.
Okay, yeah, on your toolbar, there's a little button that says mute me.
Yep.
Click on participants. It says mute me, raise hand, and then there's a chat button next to that too. So
John Gerstner, thanks for responding. He says, looks good to me / makes sense.
Awesome. All right. Well, in lieu of waiting for others that might want to join or chat, why don't we proceed, Amanda?
Okay,
So
sounds great.
We've got kind of our framework. So tell us where we go from here.
Yeah. So there's a couple things you can look at. One interesting thing is to look at the cash value of the life insurance policy and the whole life insurance and compare it with the alternative value within the Roth IRA. And as you look down the column, what you would notice when you're comparing those two, so over here, if you're seeing my screen, the whole life insurance cash value, and you compare that with this alternative cash value or alternative value of the Roth IRA over here, what you'll notice is that they go back and forth. Sometimes the alternative value is higher, sometimes the life insurance is higher. What you'll notice if you look at the life insurance, the whole life insurance side, is that cash value is always increasing, whereas the alternative value is going up and down and up and down. One of my favorite years is here between year 8 and year 9. I got a big decrease there at $19,000 less.
So you had,
and then the next year I get.
Sorry to interrupt you, Amanda. I apologize.
Fine.
So you had $59,000 in year 8.
Yep.
43 years old, and then the next year you had $40,000, and then so go on. So I'm sorry to interrupt you. So the following year you drop 19 grand, and then what happens next?
And then I go up 18 grand to 58,000. That is basically what happened in 2008. If I had this account then.
Now you also lost 2 years of time, and right. I don't mean to get ahead of you here, but you also pumped in 12 grand of your own money to get back up to 58,000.
Exactly.
Okay.
And even though I lost 19,000 between year 8 and year 9, I still paid almost $1,600 to whoever's managing my money that year in terms of the fees and the fund fees and all those things. That's actually the next thing we could look at is the alternative cost versus the whole life commission. You might have heard that people who sell whole life insurance get paid a lot of money, and it cost that cost is too much. The agent commission is too high. That's actually why we sell life insurance, is because of the commission. What you'll notice as you look down the page, yes, in the first year, the whole life insurance commission is almost double the alternative cost of the other side with the Roth IRA and the term insurance. But after that, the commission is way lower for the life insurance than the cost. And in fact, the cost for the alternative option continued to go up because it's a percentage, right? 1.5%. So as my alternative value goes up, my costs are going up too. And I've got a nice, yep.
One question I had is, I wanted to see in that hypothetical year 8 and 9 and 10, how did so you're saying the alternative cost, that's another way of saying assets under management fee for your Roth IRA. So you your investment advisor and the financial institution isn't doing this for charity, and they're going to take some of what was the approximate? Was it 1%, or what was your fee that they?
I did 1.5% because that's the average for an
That's the
IRA.
average, according to the Department of Labor. Okay,
Yep.
great. So, but you're also including, especially in those first few years, the term insurance commission. That's how we got roughly $700 or so on the fees that were paid to the investment advisor who also sold you that term insurance policy. Is that
correct?
Okay.
Yeah.
I was just looking at year 8 and 9. It looks like he got a little pay cut because of the 2008 crisis. Is that kind of what's happening there? $100,
Yep.
roughly $200 pay cut.
Yep.
Okay.
Yep.
So he didn't feel the pain as much as you lost your 20 grand. He lost maybe $200 of payment that year. Interesting.
Correct. Yeah. Yep. Close to 300 for sure. So yes, it does go down once, maybe twice as we go down through here. Here between year 20 and year 21, he takes a pay cut too, because we're repeating the same numbers over and over again. But what you'll notice, I did a nice summary here at the end. If you take the cost of the Roth and and the term insurance, you add that up for these first 31 years, the cost that it cost me, this is if I was making this decision right now today, it would cost me $81,000 over the next 31 years projected, which is 34% of that ending value that I have, compared with the commission that the life insurance agent receives, which is $3,400, which is just a little over 1% of that final account value that I have. Quite a difference there.
Wow.
And the insurance company pays the commission. The asset under management fee, that comes out of my account value every single year.
Did you want me to tell you that the investment advisor would have made 24 times as much money? Probably not.
Right. Maybe I went into the wrong business.
Yeah. That's why there is a Wolf of Wall Street, but there is no Wolf of Insurance. Let me just tell you that right now, guys. So
yeah.
Wow. And you even broke it down in terms of a per annual expense ratio there. What is that last row there, that annual expense?
Yeah. So I've got these notes here at the bottom. So if you're looking at the thing here, so it's saying that the average annual expense is the total of all years, commissions or costs, divided by the final year's cash value or account value, expressed as a percentage.
Wow. So and what are those numbers for the listeners? How much of the investment account went to the investment advisor?
34%.
So over a 31-year period, a third of your nest egg went to the investment advisor and out of your pocket.
Yep.
Okay. Well, that'd be okay. That would be okay if we had tremendous cash returns, rate of return, right? I'm okay to pay them 80 grand if they're going to give me a tremendous return.
Right.
Real stock market results.
Yep.
In the last 20 years. Okay.
Yep. So, we talked about how the account values fluctuate. Sometimes the Roth is higher, sometimes the life insurance is higher. If I look at the bottom line in year 31, the Roth only has $236,000 and some change in it, whereas my life insurance cash value is $299,000 and some change. That's quite a big difference there.
Wow. Okay, and that's incredible. So with the whole life insurance, there is a high degree of confidence and certainty and guarantees built in that number is going to be there. You're assuming current dividends on these numbers, I assume. Is that right?
Yes. Yep.
We're in the low interest rate environment that we're in, which dividends are not guaranteed, guys. But we're looking at low dividend rate environments and projecting that out over the next 30, 31 years. And Amanda, what you're telling us here is even so, we have an additional $60,000 in cash, just in terms of the cash value on the whole life side?
Correct. And our life insurance death benefit has grown to $619,000. What's the death benefit of our term insurance policy in 31 years?
Well, up to year 30, we had a death benefit of $475,000. But you mentioned earlier that we've got a 30-year term insurance. So that means it expired at the end of the 30th year. So we now have $0 of life insurance.
Mm-hmm.
And all we have to leave our family is the $236,000 that the investment account, the Roth IRA, was able to give us.
Yep.
Wow.
Yep. So I really like what happens in these first 31 years. You can kind of compare and contrast the two, but it gets really exciting what happens after this. Before we go to that, I want to just take a really quick pause, see if there's anything else we should explore with these first 31 years.
I don't have any questions yet, but one of the things I'm thinking about is access to the funds for a young person. If it's all awesome later, why would they want to do this strategy, grandma's strategy, versus the other strategy? Like, how is the funds and the differences there? Does that make sense?
Yeah. So I've got a 1-year-old right now. Let's say in 17 years, I'm thinking about helping him pay for college. What you're kind of asking is how could I use any of these funds to help with that, and what would that look like?
Mm-hmm.
So this is one of those interesting things where let's just look at 17 years when I'm 52 years old. My IRA would have 189,000 projected in it, whereas my whole life insurance cash value is only 133,000. So it looks like I have a bigger college fund for the Roth IRA. But what happens if I take that out and use it to help pay for college? Mark, do you know what happens?
Give it to us. Run with it.
No, I want to hear from you.
Well, if you had to take money out of the college fund for something other than college costs, you get penalized.
If I use my retirement money to help cover college costs.
Oh, if you pull money out of your retirement account for anything that's a quote prohibited transaction, then they're going to put a 10% early withdrawal penalty on the Roth IRA.
Yeah. So let's just say that's 19,000 that I lose. I still have more money there in my Roth IRA than in my cash value life insurance policy. But what would happen if let's say I use 100,000? That's what it's going to cost for college. What happens to the 100,000 net tax or net penalty, all of that from the Roth compared with what would happen with the 100,000 that I take out of my life insurance? One thing is that Roth IRAs I was surprised when I learned this. You can't do a loan from a Roth IRA like you can a 401k. So I have to take that as a withdrawal. If I want to put it back in, I can't. I'm still limited to $6,000 per year. If I take the 100,000 out of my bank on yourself type whole life insurance policy, I have the option to put it back in, and that 100,000 that I borrowed from the general fund of the life insurance policy, it gets charged in interest, but my 100,000 that's still in my cash value still grows as if I didn't touch it. And so I don't lose any of the growth. If I pay back that 100,000 over the next 10 years with that little bit of interest that the insurance company charges me, by the time I'm 62, paid that back, I'm going to still have $256,000 as my cash value with my life insurance policy. With my Roth, who knows what I'm going to have, right? Because I took out that 100,000, I couldn't put it back. I lost any of the gains that I could have gotten on that money. So pretty big difference there. Thanks for bringing that up, Brandon. The accessibility component there.
Yeah, you're right. Liquidity is huge for all the times we might need to spend this money over the next 30 plus years. Wow. Great.
Well, yeah. And I was going to add with, I did a similar strategy for a client and showed him his numbers with the Roth and this. He also wants to go into real estate or is in real estate. And so by you putting everything in the Roth, and it's a challenge because you can't really grow that real estate venture, and knowing that, he has this slow and steady policy but he's also really leveraging the policy for growth outside of his vehicle. And that's was really exciting to him.
Well, for one more thing that might be exciting to our listeners, whoever gives the best question or comment, whether live or chat, and we'll give favor to the live. I will be giving out a gift card, $100 gift card to your favorite Amazon.com. So wherever that might be. So if folks would like to give questions, feedback, that is something that we're ready and willing to do. So who has a comment or question that you guys would like to bring to bear on what Amanda shared thus far? Or if not, we can move on. But always, if you want to put yourself in the running, it has to be a chat with a great question or a live comment or question.
And I think that the probabilities of getting it are pretty high.
Yeah.
So
Brandon, you're in the running too. No, just kidding. Just kidding. What thoughts or feedback does anyone have thus far on what we've shared? Or questions that you'd like to bring up we haven't touched on yet?
Yeah. While we're waiting, I want to say one thing positive about the Roth IRA / buy term side. If I died anytime early on, my family gets more of a death benefit. They get the death benefit and the account value. So, like let's say I died at 45, Brandon, my husband, would get the 475 plus another 58,000. Whereas on the bank on yourself whole life type side, he's only going to get 392,000. So if I think I'm going to die young, or I'm very certain that I'm going to die young, maybe I would consider the Roth IRA and buy term strategy. But my dad passed away when he was 86. My mom is still living. She's I shouldn't say her age, but she is older. It's very unlikely that I'm going to die that young. So for me, that's not an appealing reason to buy the or to do the Roth IRA and term strategy. But for some people, that could be. I don't know.
Amanda,
any thoughts about that, Mark?
Well, first, if I knew I was going to die early, I'd skip the Roth IRA and just buy as much term insurance as I could get.
That's true. Yeah.
Because that would be the best benefit to the family, not the Roth IRA. Only because I have no clue what the Roth IRA is going to pay my family, and it would be, a guess as to what the stock market would be doing when I decided to graduate. So if I knew I had a certain deadline on my date, as long as an insurance company would get it to me, I'd get as much term insurance as I could get at that point.
Right. Yeah. And one thing you could think about too is doing the cash value life insurance side and adding some term to it if I really wanted a higher death benefit as always an option as well.
Mm-hmm. Great.
So I had a question here from LV. Not sure if she or he name is LV or what, but probably initials, I would think. So they asked, and I'm using they because I don't know, what if you have a lump sum in the midst of the 30 years? Can you add in some manner?
Oh, such a great question, LV. I love that question. So with my Roth, if I wanted to put in a whole bunch of money, let's just say I get a big windfall. Let's just use $25,000. Could I put that into my Roth? Nope. I'm limited to $6,000 per year, and I can't go above that under current law unless they change the law for some reason, which I think is unlikely. But with my life insurance policy, there's a fun stipulation. When we build these, we often build in some wiggle room. And I can fill in wiggle room in this particular policy. So every policy is different. You want to make sure this is true for you if you were to start this. But let's just say year 10 here, I've got $25,000. I might be able to fill in my wiggle room for year 8, year 9, and year 10. But it's unlikely to be $25,000. It might be $600 for each year. So that's going to be $1,800. that I could fill in wiggle room wise here. I could also pay off any loans I have outstanding on my policy if I bought a car or something like that within those first 10 years. And I always have the possibility to start another life insurance policy on me, on someone that I am close to within my family, a business partner. With the Roth IRA, I can only have the 6,000 as my limit for that. I would need to be looking at something like a 401k or a brokerage fund or something like that. It couldn't fit into the Roth IRA. And I'd be looking at the same kind of options, having to pick the stocks and bonds and mutual funds within that and all that kind of thing too at that point. I hope I answered your question. Please follow up with the clarifying question if you needed.
They asked, how many policies do you have, and are there uses for specific purposes? And they said, yes, thanks.
Okay, great. Yeah, so within my family, I love being totally transparent. I have a policy, and then Brandon has a policy on himself. And then I consider my mom part of my immediate family. She lives with us. We help take care of her. She actually has 3 life insurance policies as well. She's given me permission to share that. There is the opportunity to have multiple, and we're thinking about starting a new one pretty soon, more for business reasons. The first 2 that I started and that Brandon started, those were really there as a retirement strategy, but we've used them along the way as things pop up. We paid off our student loans with them. We helped get our business through a big flood that we had in our brick and mortar coffee shop. But really, its reason is for long-term retirement and the things that come up along the way. The next policy that we start is going to be more for business purposes to manage the taxes that we need to pay every year for our business. And then we also kind of have, one of the policies my mom started was to make sure we had some backup options in case she needed some, a nursing home care or an at-home health nurse or something like that. There's some extra benefits within the whole life that can help cover those costs. And that's the reason we started that, but it has so many other uses as well. So these types of policies, long story short, is that they can be general, or you can assign them to specific purposes if you want to make sure, like, here's what this money's for, here's what this money's for, here's what this money's for. It's totally up to your style and how you want to do things.
And she also did one on you because we're caretakers. And if Amanda happens to go, then she's going to need something to help her.
Yeah.
I mean, not just me, of course, I'll help her, but that would be a good thing. And she started a policy on our son she wanted to give college education. So then she started one on our son. Every year she contributes a little bit, $1,200 a year to the college fund for him. So they have different purposes. John asked, how can you use these specific policies to more effectively pay taxes?
Yeah, that's a great question, John. I kind of snuck that one in there on you when I was talking about the next policy that we're going to start. And this is a strategy I learned from the one and only Mark Willis. And I'm really excited to see how it's going to work for us. Basically, what it means in a nutshell, which again, you want to look more deeper than this, but in a nutshell, we can take the money that we are planning to pay in income taxes to the Internal Revenue Service in April next year. Our plan is to put that into a policy in December along with some additional funds, so that then when April comes, we can use that cash value, take a loan, and pay the Internal Revenue Service. And then kind of go from there.
Yeah,
Sorry,
Amanda, go ahead.
Oh, I was going to say, we still have to pay our taxes. It's not going to avoid any taxes. It's just a way to have that money continue to grow for us, even while we continue to pay our income tax.
It's a tremendous concept, Amanda. I love it. And if folks want to hear more about that strategy, we did a full webinar on this. Go to the show notes of our episode 84. episode 84. You'll see a webinar showing exactly how this strategy works. And check out also episode 87, and you can listen to us describe it in a short, concise podcast episode. Episode 87, How to Get Wealthy While Paying Your Taxes. It's a pretty crazy, awesome, mind-bending concept that is working. I've used this strategy myself for my own major tax problems the last few years, and many of our clients as well. So very good question. Very good question, John. So Amanda, I know you mentioned you have more to cover. So Brandon, are there any other questions right now in the queue that we have to run through, or are we ready to jump to part 2?
We're ready to jump to part 2.
Let's do it.
I'm going to go through this pretty quickly because this spreadsheet is just like the other one, same columns. We're just starting at year 24 when I'm 59. And then we're looking at what happens if I want to start taking money out of these funds. So I put $12,000 a year or $1,000 a month coming out of the policy. That's double what I put in. Right? Over the first 24 years, I put in $6,000 a year. I'm going to take out $12,000 a year. And what you'll notice is as you go through here, using all the same parameters, just continuing the calculations. So I looked at my life expectancy according to the Social Security actuarial tables, and my official life expectancy according to statistics is 82. So I highlighted what happens if I pass away at 82. And then I said, well, what if I live longer? Because that's totally possible. And what you'll notice, if I'm taking out the $12,000 at 82 years old, I still have projected $32,000 in my Roth IRA. I'm still paying $900 a year for the management of those funds.
At that point, yeah.
At that point, yep. And my cash value on my life insurance side, my whole life insurance side, has $72,000, so about $40,000 more, and I still have $175,000 of death benefit. In addition, that would still go to my beneficiaries if I passed away at 82. With the Roth side, my beneficiaries are just going to get that $32,000 left in the Roth.
Your term insurance expired at year 30, and we're looking at year 47 now. So you've gone 17, 18 years or whatever since you had any kind of death benefit or life insurance on the Roth IRA hypothetical, but on the bank on yourself, dividend paying whole life, you do still have some death benefit. Now it's decreasing. Can you tell us why our death benefit and our cash value are decreasing one more time?
Yeah, it's because I'm taking money out of the policy. I'm taking that $12,000 out per year. You'll notice at the beginning, the cash value is not decreasing by $12,000, partly because I'm still getting some of that growth in the policy as things go as well.
I want to also point out for our watching audience that there is 0 commissions paid to the advisor when you stop putting premiums in. The commissions stop, whereas the investment advisor is being paid a slice 1.5% of your nest egg, no matter how long you have. As long as you've got money in the pot, in the kitty, so to speak, of your Roth IRA, they're going to get paid, even if you're not contributing to that Roth IRA. Not so with the whole life design policy. Yeah.
Yep. Good point there. Thanks. I almost skipped over that.
One thing I wanted to, on that other page, I forgot, I don't know if you mentioned this, but when you reach 400,000 or so in the Roth, the costs of growth and the cost, if that makes sense, and
we didn't get there on this side, but if you take 1.5% of, I think it's about 400,000, the fee ends up being $6,000.
Oh, yeah.
So if you're limited to $6,000 going in, then you're just basically covering your fee each year.
So Amanda, say that one more time. So the Roth IRA, if it gets to a certain point, it's paying a fee at 1.5%. So the balance on your Roth IRA, if it gets to, what was the number?
I think it's 400,000. Let's do that math. If I take 400,000 and I take a 1.5% fee, that's $6,000.
Okay, so if anyone listening has a Roth IRA with somewhere in the vicinity of a 1.5% fee and the balance is getting close or even close to $400,000. This could be a Roth 401k as well. And you're putting in $6,000 a year, then that essentially is servicing the investment advisor's retirement, not yours.
Yeah.
Exactly.
I think I remember this from the case I was working on.
Wow.
Yeah.
But I thought that was interesting, that magic number. And I think people need to have more than that in their retirement account. I don't know.
Yeah, that's phenomenal. I'd never thought of that before, guys. Very cool. Well, what are others watching, listening, thinking of? What questions does anyone else have? And comments, feedback, reactions.
Yeah, any reactions, put it in the chat, or if you want to go live, you can ask your questions live to us.
What are we not noticing? What are we failing to see or take into account? No wrong questions or comments. We won't call you out. We'll be very kind with anybody's question, whether simple or very complex. We like that pregnant pause, right? We floored them, Amanda. You answered every possible question.
Just kidding. I would love to know their thoughts in general, like if they are more in the Roth camp, term camp, the bank and yourself camp. I don't know who these guys are. Maybe they're connected to you, Mark. What has been their experience? I'd love to hear people's experience themselves with their strategies and how it's worked or hasn't worked for them.
Yeah, this is your chance to be on the Not Your Average Financial podcast. Raise your hand, unmute yourself.
While they're doing that, I'm curious if you'd want to talk anything about the side benefits of the whole life insurance. We've talked about how accessing the cash value is a number not seen on this screen. We've also talked some about the flexibility here, but what about the death benefits ability to be used for long-term care and assisted living that we cannot get with a Roth IRA?
Yeah. So like one question that I might ask is, let's say I'm 62 and I have a stroke. And that's something that's totally possible. That's what happened to my mom. So I have a stroke, I have to go into a nursing home. It was, really bad thing here when I'm 62. I still have some term insurance at that point because only you're 27. Depending on that term, there could be some of the same benefits, but I think they're less often added to term insurance like they are to whole life. But for sure with the whole life insurance, my death benefit is $503,000. I could access up to 75% of that death benefit to help cover my nursing home costs, or maybe transition to being at home and paying a nurse to come visit me at home. And my family would still get the other 25% when I pass away.
So that's $375,000 for a nursing home to cover that expense. That's money more than your cash value, a lot more. And certainly that would give your family a big relief to not have to come up with that expense.
Correct.
Wow.
And the other option on the Roth side is that I use the $227,000 that's still in my account balance to help cover those costs. So it's not as much. And once I use that money, it's gone. Let's say I make a full recovery. I'm not going to have the $12,000 per year, probably maybe for the rest of my life.
Amanda, could you scroll down to some of your assumptions while we look for other people's comments?
Yeah, these are the same assumptions from the previous page.
I do have LV said that they should have started boy sooner, age 60 and just starting boy. What about an older person strategy is what they asked.
Yeah.
I feel like we hear this all the time, and that's kind of why we started this Roth thing, because all the older people are always like, I wish I would have started this sooner. And then the young people think they're going to live forever. And so we created the Roth
comparison.
comparison.
Yeah. So the cool thing about this is that it is customized to any age, any gender, any circumstance that you find yourself in. So we could take, let's say you're thinking about if you're still working at 60, do you continue contributing to your 401k at work? Or do you maybe shift some of that into a bank in yourself? We can do those kinds of comparisons with whatever age you're at and with what you have to work with. We love doing these kind of things. We do it every day. Um, the the advantage that you have at 60 years old is that you might be able to do more than 6,000 per year. Maybe you've got some assets in a couple different places that you could move over to help with that. Typically a 35-year-old, we don't have any assets, or we have very few. So doing some repositioning can be a lot of fun to compare. What if you left it where it is? Or what if you repositioned it? And how would that work? And how would that benefit you over the next, 30, 50 years of your life?
And LV, the episode 91, hate to point us to more episodes here, but if you'd like,
great.
Check out episode 91, the single premium solution. There's a big spreadsheet on there for someone who's definitely older than, wiser than 35 years old. I think I have a lady named Mary on my example of her starting at age 61, putting in a lump sum. As you mentioned, Amanda, great stuff. Great stuff.
I might add on that one, like if you're 60, you've now don't have that 59 and a half thing, rule, penalty, whatever you want to call it. And the idea of moving some of that money over the next 5 years because of the taxes more than likely will go up in a few years. And so if you're at that time frame, it's kind of like the golden years of being able to start these kind of things right now and getting the taxes at a low tax rate and being ready to you also don't have that penalty on the other end. So might be a great time to start.
Are folks able to unmute themselves if they want to, Brandon?
I can unmute all, but I don't know if that's a good idea.
For folks, yeah. Okay. As long as other folks are able to, that's fine. Would anyone like to come on live and ask a question? You get bonus points for that Amazon gift card. We're only going to go for a few more minutes, guys. So now's your chance, and then we'll wrap up.
John Gerstner had a question: as how are mutual life insurance companies coping with today's low interest rate environment? God forbid we see negative interest rates. Has there been any market commentary of late reviewing how whole life would perform in that environment? I'll let Mark answer that one.
Oh, that's an easy one. Yeah, happy to. Yeah, the key is the insurance companies are the best house in that neighborhood. If we go into that zombie apocalypse of negative interest rates, they would be impacted. There's no getting around it. One thing that I think is really powerful is they are contractually limiting their exposure to negative interest rates with policy loans. Isn't it interesting that they put in our contract that the lowest our interest on policy loans can go is 5%? Now that's actually a juicy return for the portfolio of the insurance company. If the rest of the world is in negative interest rate territory, you better believe that the insurance companies that offer policy loans are going to be doing better with their 5% juicy returns off policy loans. In fact, they already are. I speak with executives of these insurance companies all the time, and they're thrilled at getting that policy loan interest rate. For the folks that don't pay their loans off, hopefully none of the folks on this call are stealing from their policy loans and they're paying them back like a real banker would want you to. But for the policy holders that are not paying loans off, that's 5%. 5% is pretty good if you go into negative interest rates. John, that's a great question, man. Great question. Would you want to have any follow-up question or ask any further question there or clarify anything? If so, feel free to raise your hand or unmute yourself, but happy to ask any or answer any other questions.
up. I
Can you guys hear me?
Yep, he's on.
Yeah, no, Mark, that was a great answer to the question. I think that makes sense, and that is a very interesting aspect of whole life insurance in general.
It's literally written right on our contracts pages, 5% or another higher number. If the Moody's Corporate Bond Index goes to 15%, they'll raise the policy loan interest rate as well, but it'll never go lower than what it is today.
Excellent. Thank you.
Yeah, fantastic. Really, really smart question. Would anyone else like to come live and ask a question? Okay. Well, Amanda, why don't you wrap us up with no one else?
Wait, I got one. Sorry.
All right.
Missed it here. LV said, do you expect to see tax changes that would affect Boy if we had a Democratic president?
Great question, LV. So we've seen tax changes in the past. Actually, I think it was under a Republican president back in the 80s. Where they changed the tax consequences of life insurance policies. That was a Republican president at that time, right?
Mm-hmm.
Yeah.
Yep. Mm-hmm.
So it could be a Republican, could be a Democrat. But what they changed the tax policies were to create the ceiling that we can't go above, or else the policy becomes taxable. You heard me mention that a little bit earlier. That was in 1987, I think. And the cool thing that they did was every policy that was already in force at that point was grandfathered in, and the new tax law did not apply to everybody that already had a whole life insurance policy. What we anticipate, and I think what we've heard kind of from rumors of backroom discussions of if they did some kind of tax change that affected whole life insurance, is that they would also grandfather everyone in that already has a whole life insurance policy, just like they did the last time. So that's kind of what we anticipate. But also, even if that's what they did, there's still all kinds of other cool advantages of high cash value whole life insurance with a dividend paying company that would still be tremendous and would continue to make it a smart thing to do, even if it was going to be taxed in the future.
Yeah, I don't do bank on yourself only for the tax-free accessible cash value. That's an extra bonus, no doubt about it. But yeah, great point, Amanda. Let me wrap up with just a quick comment or two. And again, feel free to interrupt me, guys, if you have another question or would like to come live. This is your time to hear your voice, not the other way around. So you get plenty of time to hear us yak on the episodes. But Amanda, what are the problems with the whole life policy with regard to the Roth IRA? What costs? You've brought up a few of them already, but I just want to reiterate that you looked at this with clear eyes, right? You wanted to know for yourself which of these two routes would be the best case scenario, because you can do both, right? You're able to do Roth IRAs for clients. You're able to do dividend paying whole life insurance for clients. So what is the advantage here, one way or the other?
Yeah, so if you just look at the cash value of the whole life insurance policy, you'll notice that it doesn't catch up to the premium that you're paying in for the first few years. And that's because it's not just the commission that's part of your cost. There's also costs to the life insurance. They're insuring you. They have to pay that death benefit if you pass away right away. So the commission's not the only cost there, and those costs are reducing your cash value at the beginning, and then until the growth of the policy outpaces the cost. But those costs are always there. They never actually go away. It's just that the growth outpaces them. So one of the advantages of a Roth IRA is that I can choose when I want to contribute and when I don't want to. I don't have to contribute at any point. Whereas with the whole life insurance, I've got some flexibility, but it is a better strategy if you are making a commitment to at least 7 years of funding. And we want to go into that clear-eyed. If I think I can put in the 6,000 or about there, maybe a little less some years, a little, more some years, that kind of thing, for 7 years, then I think I would do this. But if I thought I just want to fund this for 5 years and never put another dime in, then that I don't think that would be a good option for me as a 35-year-old.
So the total cost of the whole life is 5,006, it looks like. And then the total cost of Roth IRAs is 81,000. I don't know which one would you want to pay?
Right. Yeah, which of those two? So the commissions paid was 3,402, but the overall expense between the delta of your premiums in the first couple of years, if you want to scroll up there really quick, Amanda, look at the difference there. So in the first year, you paid a delta cost of $2,400. That's the difference between 6,000 and 3,578. In year two, you paid 1,947. That's the difference between the premium you paid and the increase of your cash value. In year three, you paid $637. That's the delta between the increase and the premium there. That's a total cost, guys, all the way of $506 in the first 3 years. After year three, your cash grows faster than your contributions for the rest of your life. So it took you 3 years to overcome the cost of insurance and commissions for a grand total cost of $5,006. Everything else is gravy at that point. So there is still expenses on the whole life, but your increase is always greater on a predictable schedule. I think that's a slam dunk, Amanda. Well done putting all this together. Would you want to share with our audience here what they get because they joined and were a part of today's call?
Yeah. So I would love to run these numbers for you and have this same kind of conversation, pros and cons, which one you would want to choose. I'm going to put a link in the chat so you can just click on the link, or if you want to copy and paste this, share it with someone you love and care about, that would be great too. This is not just for you, but if you want to share this with someone, especially if they're in their 20s and 30s, I would love to help them run through these numbers. I'd also love to help a 60-year-old, and there's no age limit to this too. So you can click on that link. For those listening, the link is grandmaswealthwisdom.com/Roth. ROTH. Again, that's grandmaswealthwisdom.com/Roth. And there, all you have to do is pick a time on my calendar or on Brandon's calendar. He's also offering to do this for you as well. After you pick the time, it'll ask you for your details, including your age and your gender, so we can make sure we get the right numbers for you. And then we will run the same exact scenario for you. If you have any changes you want to make to it, you can put that into the comments on your on the appointment request as well. So we'd love to do that with people, particularly, again, this is not just for the people listening, but if you have someone you love and that you care about, that you think would want to see these numbers too, and have that as unbiased as we can be analysis, weighing the pros and cons, we'd love to help them as well.
Awesome. Thank you for that, Amanda. That's very cool. And these numbers will be made available on the show notes eventually as well. Is that correct?
Yes.
Okay. So when we do publish this later on this year, probably November sometime, this show, folks will get to see these numbers again. But if you haven't already, take a screenshot of what you see here, or more importantly, get your own numbers plugged in and let's see how it looks for you to see if this is better than a Roth IRA.
We also have an episode about this at grandmaswealthwisdom.com/ the most famous 21-year-old or something like that.
Nice.
What's the title? I forget.
I'll find it and I'll put it in the link.
21-year-old, 22-year-old.
Yeah, it's our most recent episode. So you just have to go to grandmaswealthwisdom.com and you'd see it there.
Love it. Okay, great, guys. And finally, would anyone care to share a idea they want us to do this again on? If you like this approach or this model, I suppose, or this platform to kind of get some different feedback, intrigue, insights from you, our listening audience, if you want us to do this again, put in the chat for just a quick minute what idea you'd like us to cover next time. Jack, you mentioned the the taxes concept, that might be something we might do a whole episode on and go through in a live fashion with Q&A. That'd be a lot of fun. It's a really smart idea. Would anyone have any other ideas of what you'd like us to cover? It doesn't have to be about Bank on Yourself in detail like this, but if you'd like us to go deeper into this strategy or other strategies on financial planning, give us a shout. Put it in the chat real quick, and we'll collect that. And we really appreciate your attendance and participation today, guys. It really means a lot to us. All right. Real estate, taxes, speculative asset strategies. I'd love to have that somebody who might have some insight into crypto come on and possibly be a co-host with us there. So very cool. Love it. Thank you. Okay, well,
another one was the numbers of refi versus pay off a home. That's a good one.
Cool.
We should do that one.
I'm writing these down. Good. Very cool. Who was that?
LV.
LV. Boy, it's a neck and neck with John and LV right now. So, all right. So, guys, thank you so much. I am going to randomly select a comment from my list here. I can hit this little button, save chat, show in folder, and randomly open it up. And I see the first I see is LV. So LV, all we'd need, I guess, to get that $100 gift card to you is chat Brandon your email address, and we'll make sure we get that over to you, that $100 Amazon gift card. And way to go. Thank you for your participation today. And thank you all for your participation today on our show. And also, of course, Amanda and Brandon, thank you guys for contributing and being a part of today's show. It's a tremendous pleasure and a lot of fun being with you guys today.
Oh, yeah. It's awesome.
Thank you, Mark. This has been a lot of fun. Thanks.
All right. Enjoy the day and enjoy the rest of your weekend, guys. And we'll catch you next time. Thank you for joining us for another episode of Not Your Average Financial Podcast, helping you think different about your money, your economy, and your future.